I had interviewed Pedro da Costa, who follows the Fed. He was a journalist who covers them. And as of 2 days ago, he said he didn't know exactly whether this thing was a one-off or if it was an inferred blanket to future deposits. That interview might have happened before Janet Yellen spoke, so that's an interesting piece of news. Obviously, we'll hopefully get clarity next week when the Fed has its press release following the FOMC meeting. But even if it's only a one-off here, that still raises the whole hey, here you are giving the privileged class a special, get out of jail free skate card here, right?
Yeah. No, look, and if Silicon Valley Bank had been a $2 billion bank, nobody would have gotten bailed out. The only reason Silicon Valley Bank got bailed out, and First Republic, by the way, so we need to cover that real quick. First Republic Bank got a quasi bailout. 11 major banks got together and deposited $30 billion uninsured into First Republic Bank. Now, why would the banks do that? Look, JP Morgan and Bank of America and Wells Fargo, these banks are predatory. They are not sitting around going, oh, let me help a competitor out of a bad spot. No, they would have preferred to pick over the carcass of First Republic Bank and have let it fail. By the way, Silicon Valley Bank has now filed Chapter 11, just FYI. So they would have preferred to allow First Republic Bank to go bankrupt and then just pick over the carcass, buy the loans off, anything bad debt, just let it sit there, let the Fed absorb it, whatever. But the Federal Reserve and nobody, and this isn't public knowledge, but it only makes complete sense, is that the Federal Reserve and Janet Yellen were on the phone with these 11 banks going, hey, we need you to make these deposits.
Right. And
don't worry, we'll insure you. Even though the deposit is uninsured, we will make sure that you get your $30 billion back.
Right.
But see, this is the only way that they could bail that bank out, because now we're getting past the limit of even what the BTFP program was set up for, because there's only a $25 billion backstop by the Treasury in the BTFP program. So 30 billion, you're already past it.
Yeah. So, okay. So you're jumping through my list here, which is good, but let's explain for people what happened. So after this past weekend, the Fed, the Treasury, and the FDIC said, okay, we're making those depositors whole at those banks. So everybody, don't worry, calm down, don't make a run on your bank, right? We're here to help. We're from the government, we're here to help. And then they announced this bank term funding program, the BTFP, which I'm sure you got the same chuckle I did, Lance. This sounds an awful lot like BTFD, right? And the first thing I thought, which you were just sort of riffing on here when I heard it, was $25 billion. Like, isn't that way too small? Like, there's like 18 trillion of deposits at banks. Right. Yeah. And this is not even a drop in a drop of the bucket. Like, if there's a real problem, this thing's going to vaporize in a heartbeat. And you just mentioned the bailout of First Republic is already greater than that. Right. And I've been talking to a lot of folks about this. And I just want to underscore that Danielle DiMartino Booth, who I recorded yesterday for the conference, she and I have been continuing the discussion, and we're going to get in a minute to some of the additional bridge loans that have been offered by the FDIC and the usage of the discount window. She's basically saying, look, what's going on here is big, all in capital letters. Like, this is not a small little, this is no longer about the failure of one bank that was overextended. Like, all of a sudden, this is revealing really big rot inside the banking system. Sorry, go ahead.
By the way, no. And by the way, that's a very good point. So yeah, there's two parts of the BTFP program. So the first part is basically about $2 trillion of quote unquote QE. It's not QE, but it's QE. It's expanding the balance sheet. As I said earlier, just in the last week, we've already reversed 1/3 of all the quantitative tightening on the Fed's balance sheet from last June. There was $152 billion drawn out of the Fed discount window in a week. If all the banks that are probably on the ropes have to draw on that window. Now, normally the discount window is something banks don't want to draw on, because if you draw on the discount window, everybody assumes that there's something wrong.
Right. As Danielle said, it's like basically, like covering yourself in blood and jumping into a shark-infested ocean.
Exactly. Yeah, and all the big banks are going, oh, you're at the discount window.
Yeah.
Here we go. But the draws on that discount window could be as large as $2 trillion. if you think about all the uninsured deposits that are sitting out there. So, you're potentially talking about $2 trillion worth of liquidity getting pumped back into the banking system. And we had only reduced the Fed's balance sheet by about 600 billion. So, I mean, just very rapidly, we're going to be talking about expanding the Fed's balance. In fact, I'm writing an article about this right now, is that, this Fed's QE, not QE thing is potentially going to inject a whole lot of liquidity back in the markets. Okay, so now the BTFP program, a bank can draw from the Fed. Now, here's the interesting thing about this. So Silicon Valley Bank did not have bad collateral, right? And we talked about this last week.
Yep.
The collateral was all treasuries. The problem is that when interest rates went up, the value of that collateral fell. So they had 100 cents on the dollar in bonds when they bought them, but they'd fallen in price to 90 cents on the dollar, just rough math. So when all the depositors came in and said, hey, I want my money back, there wasn't enough collateral to meet those withdrawal demands. That's the part of fractional reserve banking that goes bad when you have a bank run. What the Federal Reserve did is, normally I can lend money to the Fed and they say, okay, I'm going to give you a percentage of that collateral. I'm not going to give you 100 cents on the dollar in case you don't pay me back. I've got some excess collateral. Well, what the Fed said is, no, we'll give you 100 cents on the dollar. So no matter, and we talked about mark-to-market accounting last week, but we'll give you 100 cents on the dollar for this collateral. Now the banks have borrowed this money. Now that 25 billion that the Treasury put up, that's a guarantee of payment back to the Fed if the loan isn't repaid. So there's two parts to that program, but it's a big program in terms of bailing out the banks because, as we've said before, is that, every year we get these Fed stress tests. They come out and they go, oh yeah, well, if you have, unemployment jump to X%, or if interest rates go up to Y%, or the economy slows to Z%, the banks are fine. They're completely capitalized. It's all great. Well, that's because it was all there was no mark-to-market accounting. Everything is priced at face value. So yeah, they look well capitalized. The reality is Bank of America is one of the worst capitalized banks, but there's a lot of banks that are well below tier 1 capital requirements when you mark their book. And to Danielle's point, and this is what we've been saying for a long time, if the financial system was as well capitalized as what the Fed is always telling us it is, why do we have to keep bailing them out every single time there's a problem in the economy? And that should tell you all you need to know about how well capitalized banks are.